Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In each episode, we answer your burning trading questions and cover all things from the world of trading.
Here we are again.
We're back.
We've got some more questions and subjects for our subjects.
Yes. So we are going for our subjects. I like that. So we are going straight in with a question, and it's one that we've had similar guises to this, but I think I like this question because it's direct to the point. The person saying, I log my trades in a journal, but I don't know what to do with it. And I really like this question because it's not the first time somebody said that. And I've had times where I've even asked traders, how many of you know you should be logging your trades and journaling, but you either don't do it or you do it like this gentleman, but you don't know what to actually do with the information. So I think that's a really good point, because part of the motivation, I think part of the reason some traders don't log their trades is because if they did, they wouldn't know what to do with the information anyway. And I think the obvious reason why people don't log their trades, or traders don't log their trades, is because they don't want to see what's going on. But this person is, we don't know whether he's doing well, where he's at results-wise, but I think it's a common problem traders have with, what do I do with this information? What information do I collect? What do I do with it?
Yeah. Well, I always say that a trading journal should act like your own personal mentor. So if you're logging all of your trades and then review, this is the point. So yes, you log them, but then you need to review them on a regular basis. Go back and review. So that's where your journal acts like a mentor. Like a mentor would say, oh, why did you do that there? And what was the thinking behind this here? And, oh, did you notice that you did this here? Just like you would do if you were with a mentor. Your journal will do that for you. Log it there in the moment after you've taken a trade or whatever. And when you come back to do a review, if you're a day trader, you might review once a week or maybe twice a week, but let's say once a week at the end of the week or whenever you do it. And if you're a swing trader, it might be bi-weekly or once a month. So then if you do a review in the moment, it's too raw. You need to have come away from it and come with a bit of time. So that's why you don't review all of the time. But the great thing is that you can start to identify things that you've done right, things that have not gone so right. So the problem with, if you just look at your P&L on your brokerage account and it's down, you're like, oh God, I just lost it. Yeah, but when you've logged in a journal, you may have lost, but you may actually then strip it down and say, well, actually, I may have lost, but that trade there nearly got to its target and it just rolled over. So, there's little instances like that. Or, I just got nicked out and stopped out on that trade and it actually carried on. So the trade direction was right. I just got a bit unlucky on that instance there. And, you don't have to try and necessarily always fix something. It could be that the stop loss is too aggressive, but it might not be. And then you can put it down to just a bit of bad luck. So this is where, and that's just a couple of instances. I don't want to hog the mic on this.
No, it's good.
But this is just two instances where you start to use that information. But a classic is when you're journaling, do you actually break down the different markets you trade into your P&L per market? And you might find, and I did this years ago with a trader who loved trading gold. And it was his favorite market to trade. And he traded currencies as well, whatever. And I said, but his overall P&L was flat. It wasn't negative, it was just flat. And so I said, all right, what I want you to do is go back over all your logged trades, strip them all into a per market analysis. And his worst performing market was gold, funnily enough.
Yeah. Because
when he did get big runs on it, because gold was volatile, he remembered those big profits, but forgot about, he was logging it all, but just wasn't, it was logged all between all his other trades and didn't realize how much the losses added up on gold. And so they just stripped out the profit, and actually his most profitable market was something like pound dollar or something like that, I think. So it's very, very powerful tool.
Yeah, I think there's a huge amount in that on the, I call it the mechanistic side. So there's two sides. There's the mechanistic side, so then the numbers and the performance and the technicals, and then there's the emotional side. So something like what you've just said is hugely important about knowing which markets you trade and which are performing better. And again, probably challenging in most cases your belief about which markets are successful. I always say you want to be looking at, the key metrics are obvious: win-loss ratio, risk-to-reward ratio. But what I say to my traders is make sure you're journaling the performance of you on that trade. So what I mean by that was that trade good, for sake of argument? Could you classify it as good? Could you, if you were a school teacher, give that trade a nice big green tick, as in you stuck to your rules, you did everything right? Was it a mistake? Because the obvious one is that as a trader, you can do everything wrong. You could get in at the wrong time, break your rules, over leverage, and the trade could still show on your P&L as being a profitable trade. So it's getting away, the mechanistic side is getting away from just saying because the trade was a winner or a loser, therefore it was good or bad. So have mechanisms in place. And I'll even get traders to color code it. So if they can classify the trade as good on a spreadsheet, they write good and it's green. And if they broke their rules, they have to say, was it an accidental rule break? So after the event, could they see that they forgot to wait for price to break out of the resistance rather than they realize afterwards that they got in too soon? Or was it conscious rule break? Was it a trade where they just said, no, F it, I'm just gonna go for it because I've seen the market move, I missed a trade yesterday and I just want to feel like I'm in something and getting some profit. So breaking those things down, I think, is really important in terms of saying, well, how am I performing? And one of the things that I get some traders to do, especially day traders, is to look at their actual performance. So they take a week, at the end of the week, they look at their actual performance and then go back over the market with the benefit of hindsight and check they haven't missed trades, did they stick to all of their rules, and look at what their actual performance is versus their perfect performance. So how close are they to the specific strategy that they're trading? Now, obviously, that means they've got to be trading something quite mechanistic with very specific entries, but it gives them the chance to review the week and say, how close was I to perfect? And it isn't about being perfect, but it's easy to get to the end of the week and think, well, I'm up 2%. It's been a good week. But actually, on paper, you should have been up 4% because that was a really good week for your particular strategy. And you can do that the other way around. Oh, I'm down 1%. Well, it's been a rubbish week. But actually, the strategy, if you'd taken every single trade, you might have actually got lucky that week and you should have been down minus 3%. So giving you that perspective. And then the last thing I would say is focusing on the emotional side. I will get traders to look at how they are feeling and literally journal how they are feeling in that moment, pre, during, and post trade, because they're the three segments. What are you doing? What are you doing before you place the trade, and what are you feeling? And then when you're in the trade, what are you feeling? Are you seeing the trade coming down towards your stop and thinking, I'm going to be stopped out? And that links back to the mechanistic side. Do you know what percentage of your trades go into a losing position before they hit target? That's a metric that would help you. And then post-trade. Can post-trade so important to journal how you feel? Do you feel you were robbed? Do you feel, like you said, that price just got up towards your target and then rolled over? How does that make you feel? Because the risk, especially if you've got a short period of time between close of that trade and the next trade, which is more likely to happen on day trading, are you taking the emotions of the previous trade with you to the next trade? So just having 3 columns on a spreadsheet and just making some small notes, what am I feeling pre, during, and post-trade, gives you that awareness. Because I think different people will do different things with the data that they get from their journal. But the first most important thing is to have some awareness of how you're operating.
Brilliant stuff. It's, like we said, it is your own mentor. And I just wanted to add one little thing. When you said about being right or wrong, might be that you've lost money, but you've followed your plan. And by journaling it, you can see you did all the things right. It doesn't matter that you lost 1% that week, that month, whatever. You did the right thing. You followed your plan, your trade plan, and your trade rules. So that is a tick. That ultimately is what we're trying to do in trading, is to follow our plan. And that's it. And so too many people, as you've already said, see a losing trade as a bad trade, and that's just not the case. They should measure their success, and I don't mean as far as winning, losing, or whatever, around whether they are following their plan. And because if you are following your plan, then it puts you in a far better position to be long-term profitable than if you're not following your plan because of emotions or whatever. So I thought it was a it's such a powerful tool.
I think that's
really is.
I think that's a really good way to end that section, because actually that leads really nicely onto our last question, which is, I hear you say trading is the hardest game in town. So people have heard us talk about that. Can you expand on why? And I think what you've just said actually leads really nicely in, as I've said, because you've got to be in a position as a trader to be able to say, I've had a good week or a good month, even if your P&L doesn't show that. And I think that's fundamentally what, as traders, especially newer traders who haven't really, they haven't calloused their mind, they haven't, really got to grips with the emotional aspect of it, because you can only really get to grips with it once you actually do it. I think that's the fundamental thing, is you've got to be able to pat yourself on the back, feel okay, go through to the next week, even if your P&L hasn't shown it.
The market, I always say, the market is constantly going to try and kick you in the teeth. So you've got to get used to taking that beating all the time from the market. When we look at trader returns, for most traders, most of their returns come in small pockets of activity. That's where the returns come. The rest of the returns are break-even, stop-outs, and all the other stuff. So it's actually in a relatively, if you took a trader that had 1,000 trades, well, you could say, they've got a 50% win rate, so they're right on. Maybe, but it's not always that case. It might be of the 50%, the 50%, half of those were break even, so they didn't lose anything, but they didn't make anything either. So it's a small amount of trades that are responsible normally for a larger share of the total profit that a trader makes. So the rest of the time we're getting beaten up by the market, and that's why we say that it's the hardest game in town, because you've got to get used to rejection. The market is constantly trying to reject you. It's trying to make you second guess your own strategy, doubt your own strategy, doubt yourself. The market's just what it's going to do. It's playing with us all the time. If it can, it's like a little devil, and if it can get in our ear and make us do things or react to things in certain ways, he wins. So, and I have to say, the devil's got to be. He can't possibly be a lady. So that's why. But if we take, I was watching the golf. We had the Open just this past weekend, and I was watching a little bit of the Open this past weekend, and Rory McIlroy was being interviewed, and I've heard similar sports people say the same thing. He said, I do about 25 competitions a year. He said, if I won even 3 or 4 of those, he said, that would be an amazing feat. He said, so I spend way more time losing than I ever win, and I have to deal with that all of the time, and the pressures involved, pressure to win, the expectation, all of that. Now, that may be slightly different to trading, because he may not win, but he may still get paid a lot of money for coming in the top 5 or sponsorship and whatever. But we can still use that in a way to say there are lots of professional sports people. I've heard snooker players say this. Martina Navratilova, Maria Sharapova said the same thing. When she was right at the top of her game, she lost more tournaments than she ever won, even though she was number 1 in the world. And so in trading, we have to get used to not winning all of the time, and that rejection that the market's constantly throwing at us. And that is why it's the hardest game in town. For all the efforts and the inputs that we put in, the output is a bit erratic. And so we're not getting those wins all of the time coming through. We've got to put up with all the losses along the way.
I think that's a really good one. And it's I saw something similar recently. Roger Federer was mentioning in a graduation. I think he said he won less than 50% of the points he took. He added up all of his points, but it was the points that he did win.
Right.
And they talk a lot about being. I talked a lot this year at Wimbledon about being present. So being present in the moment and only thinking 1 point ahead. And it's a similar thing when you're trading. You've got to be very present. The challenge with trading, and I say one of the reasons it's the hardest game in town, is you have to put all your energy and focus into that trade. To get it right, do it right, make sure you stick to your rules, and it's part of your strategy, and you see it through to the finish. But you have to then take a very big perspective in terms of your results. So you have to give this energy and effort to something that you can do everything right. And it's not a case of like the golfer where you do everything right. You have a great tournament. You finish fifth. Your sponsors still pay you. Everything still happens.
Yeah.
You do everything right on a trade. You lose money. It's not a case of you just go. I mean, it might be a break-even trade, but the idea that you are regularly going to have scenarios where you are doing absolutely everything to the T, and your reward isn't just nothing, it's minus. It's money coming out of your trading account. And that takes time to emotionally appreciate. And it's a challenge all traders face, whether it's 6 months or 6 years. Obviously, the trader who's newer that emotional dial is going to be, much higher up. But it isn't a case that if you've been in the game 6 years, you don't still feel it when you get beaten down. You've learned, and if you've made it that far successfully, you will have learned strategies to cope with it. So, and I think the one thing in a slightly different angle with this is you've got to accept that it's the hardest game in town, because so much of the information that's out there is implying that it's easy. You just got to, learn a quick strategy and you're off to the races. Or the information's contradictory. So somebody will say, yeah, trading's the hardest game in town, but buy our super duper ABC strategy and you'll be up and running within 3 months. So they're saying the right soundbite over here, and then over here they're saying, yeah, but you've only got to do this, this, and this, and then you'll be fine. And people will hear things like trading is simple but not easy, but that doesn't mean subconsciously they could be sitting there going, well, because it's simple, it's going to be easy. They've heard the soundbite, but they haven't necessarily emotionally taken it on board.
Yeah.
And I think you've got to embrace it. So I think the more that you embrace the challenge, as long as that's within a context where you're not doing things you shouldn't be doing, the more you accept that it's going to be a challenge, and the more you're up for that challenge, the less hard it gets.
Embrace the uncertainty is really the key message. We have to. It's really difficult because as human beings, we want that instant gratification, but we need to embrace the fact that we're not going to get gratification for every piece of work that we do, for every button that we click when we buy or sell. We're not always going to get that, but we need to embrace that uncertainty that's out there. There's a great example from the beginning of this year. There's a hedge fund manager, I think he was in the States, and he just made just over 100% over the prior year with a 26% win rate strategy or approach, whatever his method. And I think it's a good reminder. And I'm not saying because your average retail trader should be trading with an approach that gives them a 26%, because I think that a lot of retail traders just don't have the thick skin for that. But it's a good reminder that they don't have to be right all of the time. And some of the world's very best accomplished hedge fund managers actually, and a lot of them are all in the 30%. Paul Tudor Jones was historically, and many others. It's not about being right.
I think that's a great point to end the show.
And on that note, his name's... No, it's not. His name isn't Charlie Burton. And
his name isn't Ali Crooks.
Take care. Safely.